Hello, and thanks so much for checking out the Coin Stories podcast video page. I'm Natalie Brunell, and normally I talk to the leading voices in Bitcoin, but today I have a very special episode with one of my favorite guests talking about the big economic picture at large and whether we're headed for a major crash. He's one of my most popular guests from the past. But first, I do want to share this podcast does not provide financial advice. It is for educational and entertainment purposes only. I'm super excited to share this episode is brought to you by the Bitcoin Conference 2022. I'm so excited. I'm going to be a speaker this year in just 2 months. That event's going to be held in Miami, April 6th through 9th, and it's going to be the biggest Bitcoin event in the world. All 4 days will be jam-packed with exclusive content, exciting announcements, and an incredible lineup of Bitcoin speakers, artists, and leaders. Day 1 is Industry Day for enterprising Bitcoiners who are looking to build a business or career within the ecosystem. Days 2 and 3 are general conference days featuring speakers like El Salvador President Nayib Bukele, who has promised a big surprise at the event, as well as CEOs like Michael Saylor, Elizabeth Stark, Jack Mallers, Adam Back, and hundreds more. The conference caps off on the 4th day with the world's first and largest Bitcoin music festival, Sound Money Fest, headlined by rapper and fellow Bitcoiner Logic. You're also going to hear from Steve Aoki, CL, Run the Jewels, deadmau5, and many more. Last year's conference sold out, and this year's is on pace to be 3 times larger. So make sure you grab your tickets before it's too late. You can head to b.tc/conference and use the code COINSTORIES for 10% off your pass. Make sure to get those. They will sell out. This portion of today's episode is sponsored by SoFi. With SoFi's all-in-one platform, you can save, spend, earn, borrow, and invest. You can buy stocks and ETFs, open an automated portfolio, or my favorite part, start accumulating Bitcoin, all with no account minimums and 0 commissions on trades. Whether you're new to the world of Bitcoin or you've been dollar cost averaging or trading like a pro for years, SoFi has something for everyone. If you head to SoFi.com/Natalie and sign up for a SoFi Active Invest account, you can win up to $1,000. Thank you so much to SoFi for sponsoring this portion of the episode. All right, there's a lot happening in the market, so I wanted to bring back one of my favorite and most popular guests, David Hunter. Now, David is not a Bitcoiner, at least not yet, but he's a macroeconomic strategist with 48 years of experience on Wall Street. Very popular on Twitter. His handle is @DaveH_Contrarian. And he's a contrarian because he predicts a massive historic deflationary bust that represents the greatest financial crisis in history. And he says it's pretty much right around the corner. Now, the United States keeps doing a good job kicking the can down the road with stimulus, quantitative easing, money printing, but the music can't play forever, right? So David says that he sees indicators that we're headed for the end of this decades-long secular bull market, which he believes is going to culminate with a melt-up rally that's going to spark euphoria and everyone pouring into the market, followed by drawdowns of 80 to 90% in this historic bust, followed by a recovery that's going to shift everybody's allocations and that could put our whole financial system in jeopardy. And the decisions you make between the melt-up to the bust to the recovery will essentially determine your financial future. So I'm dividing this interview into 3 sections because I really want to hone in on David's thesis. The first is that melt-up rally, which David says is now underway after that correction in equities we saw a couple weeks ago, followed by the bust, what signs to look out for and what it actually means and what it could look like when all of this credit starts to unwind. And then finally, the recovery and what to do in the future as you plan out the next 5-10 years of your life and how to protect yourself and your family. So really important interview. Really thank David for his time. And without further ado, here he is.
The authorities will respond to the economy with massive money and massive fiscal spending. Means you won't be down long enough maybe that we just totally go into absolute anarchy and chaos. There's a bigger cycle coming, I think, after the next recovery, and in that one I can see all of that. But I think this one probably is going to be mostly financially driven, wealth driven, and food shortages and things like that are happening anyway. So we could see certainly some of that, but I'm not so worried that's why I call it a bust rather than a long drawn out depression. I'm not so worried because I think this one's pretty fast. It's devastating while we're in it, but we come out of it pretty quickly and relatively. I mean, it won't feel like you're coming out quickly for the year you're in it or the 15 months you're in it. But on a relative historical basis, that's pretty quick.
Yeah. Well, that's all really interesting. And I feel like at a macro level, we're kind of setting up the collapse of the entire system as we know it. So let's focus on the recovery though next, last section of our interview. So money printing will spark investment, right? They're going to initiate more money printing than we've seen, even though it's been historic in the last 2 years. Commodities will rip. The leaders from the market now will recover, but they won't lead again, right? So how does the recovery ensue? What do you see happening?
Yeah, so with a lag, you'll get, let's say we have a bust later this year. It'll take them time to get to a right-sized policy. So you'll see them put a couple trillion in, which is a big amount, kind of like 2020, and it won't stop the bleed. So they'll come back and put another few trillion in, and it still hasn't stopped the free fall. And again, this stuff can happen in a matter of weeks or months, it won't be years. And they go, this thing's still going, what do we do? So they put another, 5 trillion in or whatever. It's going to take time for them to find out what level finally stops the bleed. And it doesn't mean you won't have bounces. You'll have the market go down and then have a, counter and rally and then down again. But they're just going to be, they're in uncharted territory, so they're not going to be, and they're dealing with money levels, magnitudes of money that are way beyond anything in history. They did show a quickness in terms of moving beyond anything we had seen in history back in March 2020. Powell, I give him credit. We don't. Our balance sheet, the Fed's balance sheet was 875 billion going into 2008-9, or October 2008-9. October 2008. So to go from 875 billion as your high watermark in history, and then all of a sudden in March 2020, you threw another, between March 2020 and now, threw another 5 trillion in. I mean, those are numbers way beyond any, he's certainly not using history as a guide. He's doing what he has to do. And that's what this is going to be times 10. And so, I think it will take, but the point is it will take time for them to get to an amount of money that stabilizes the free fall, stabilizes the economy, stabilizes the markets, and begins the turnaround, the reversal. When the reversal comes, which there's a lag. When you get there, it's several month lag. So from the time they're printing to the time that it turns the economy is probably 6 to 9 months. Mm-hmm. So let's say it's second half of 2023. It's not going to feel like you're out of the bust or the downturn, but you will be. Just like in the market turned up in March of 2009. It didn't feel like you were in a recovery until well into 2010. So it's the same kind of thing. You can be statistically in recovery, but you're not going to look around and say, "Wow, things look a lot better now." Phew, we got through that. Mm-hmm. But I do think the market will turn first, and then, as it always does, and then the economy after that. And it will be entirely different leadership. It will mean. And also keep in mind, I always talk about money, but if I'm right that the 10-year drops from 2.5 is my call for, the next several months in terms of the tightening, the high water mark down to 0. So if you have a 0% 10-year and the economy begins its turn, there may be a bounce in housing because mortgage rates are 2%, or, it won't happen in the middle of the bust when rates are at their bottom, but those rates may stay low for a little while because there's a lot of money being printed. And so the first year out of the recovery, you probably are going to have the headwind of the damage done to people's wealth and the damage done to people's psyche that will keep housing down. But in maybe the second year of recovery, you might get a bounce, but I don't think you'll get anywhere near back to the highs. And then as you go along, as you get into the recovery, the rate's going to move up pretty fast within probably second or third year, you can begin moving into new high territory where you're, 4 or 5% in 10-year interest rate, and on the way to double digits. I think by the time we get to 26 or 27, you could be in double digit territory for the 10-year. And again, I'm throwing out dates that I could be off by years. But the point is, you're going to go from very low rates that have been low for a long time to rates we haven't seen in 40 years, ultimately, where I think by the end of the decade, you're at 15% 10-year, maybe higher, 20% T-bills, 20+% inflation. And that's coming from just a few years before, or 7 or 8 years before, deflation and 0% interest rates. So, it's going to be a huge turnaround. And that's what happens when you pour an extra 20 trillion into a system, and around the world, probably an extra 100 trillion.
Well, won't that push trillions of dollars out of bonds? And where will that money go?
It's what will happen is that people will find out the hard way that their bond portfolio is going south because interest rates are going higher, and ultimately people will catch on. But early on, they're not going to realize that, I've owned bonds for years, and it's been a good stable place. If you go from 0% 10-year to a 15% 10-year, your portfolio has been decimated. So along the way, you'll have a lot of allocations moving away from bonds, but it won't happen early. It will be as people recognize they made a mistake in being in bonds.
Yeah. Well, I know a lot of people are talking about how the 60-40 portfolio is dead, and us in the Bitcoin space, we really think that money will come on to Bitcoin. So
good luck. Well, good luck with that.
Well, tell me, after the bust and as we start the recovery, what does life look like for the average American? Because, I would argue that in a bust like that, won't they have a hard time participating in the recovery?
Yeah. It's really hard for me to envision it. I can throw around the numbers and the markets and stuff. It's really hard to envision how this isn't going to be, in other words, to answer your question, what I will say is there'll be lingering effects for a long time. You don't go through what if I'm right, we're going to go through, coupled with what we just went through with the pandemic and all the changes that has led to. You don't go through all that and then magically come out of it because they printed money and the market's back up. So I think the decade, even though we will have, and I say this, I contrast myself to some of the real gloom and doomers that say we're going down for the count, that this is the end of the cycles. I go, no, we have a recovery cycle because the printing press is still active. They still have the ability to print. Even though I believe that does not mean the decade ahead is all, cherries and whipped cream. It's going to be tough. There's going to be a lot of people that got hurt and don't come back from it. There's going to be, there'll be haves and have-nots like there always are coming out of this. So that's why I think the real message is how you deal with this, how you prepare for it, how you deal with it can be all the difference between you being one that can be opportunistic about what's coming out of this versus those that are digging out for a long time.
Well, I want to get to that as we wrap up the interview of how you prepare. But first, in your forecast, what is the rate of inflation in that type of money printing environment that's unprecedented? And isn't your forecast that essentially that inflation will tie the hands of the Fed and eventually bring the whole financial system down and eventually, pushed out years, we would have this long depression and possibly, authoritarian governments coming in? I mean, that's a really serious forecast, especially down the road when you look at the consequences.
Yeah, I look at, my forecast is that we will, as I said earlier, see 20% inflation. 20% plus inflation. So what I'm calling for is basically a retrace of the last 40 years. In the early 80s, 1981, we were at 20% inflation and 20%, 21% T-bills. That's what I expect us to do, is a full retrace. Whether we'll go beyond that retrace, I don't know, but I expect a full retrace. So at least 20% inflation. If I'm right, and interest rates, people don't understand this because people say, well, the Fed won't allow that. They won't let rates go that high because we can't afford it. It's not in the Fed's hands. It's in the market's hands. The interest rates will, in the long run, track inflation because you have to have purchasing power. And so you will see, rates follow inflation. And so if we're going to see anything close to the numbers I'm forecasting on interest rates, the equation doesn't work. You can't. We will be unable to meet our service costs for that debt. Because don't forget, when I say we could expand the balance sheet by 20 trillion, coupled with that will be an equal amount of expansion from the government. So there'll be another 20 trillion in government debt. We can't. You're not going to be able to service that. You're barely able to service it when rates go from where we are now to 3%. If they go from where we are now to 10%, we can't meet the obligation. And then it goes beyond that. So a lot of what we do now is roll T-bills, because T-bills are almost zero in interest rates. So we're instead of locking everything in at 1.5% or 1.75% on a 10-year, to lock in that interest rate, lock in your cost, they're rolling most of it. So if you roll it and the T-bill rate goes from close to zero, and in the next decade goes from there to double digits and ultimately 20%, you're not going to be able to cover that. So what will happen initially is they'll try to cover it by floating more debt. They'll say, well, we have we have to meet our obligations for Social Security. We have to meet our obligations for Medicare and Medicaid. We have to meet our obligations for the military. We have welfare to cover. We have all these other programs we have to cover. And yet all our revenues coming in are not enough to cover just the servicing of the debt. Right. So initially they'll say, okay, well, we got to sell more debt. We may not like to do this, but we have to. But what happens is as you sell more debt and you monetize it, the Fed buys it because nobody else is going to want it. You end up creating more inflation. It's like going to a California forest fire and saying, we don't have any water around. Just use that gas pump. We got to have some fuel on that fire. We got to try to put it out. Well, the fuel you're putting on the fire is just going to make it bigger. Yeah. And at some point, you just can't. So, So I think ultimately that's the problem, is that the Fed won't be in control of it. It'll be the inflation that'll drive rates, and ultimately it leads to a point where the Fed's out of the game. As I say, the only reason people don't notice that our standard of living has dropped over the last several decades is because of the expansion of the government. When you take the Fed out of the game and you take the government out of the game, because they won't be able to sell bonds at some point, people are going to say your credit's not worth a thing because we know you can't cover your debt. You can't service your debt. Once you stop that, the Ponzi scheme's over. There's no more, well, we can just keep selling more debt and, pretending we have money. When you can't access capital markets anymore, the game's over. The music stops and it collapses. And
so the dollar collapses at that point, doesn't it? Or I mean,
the dollar will be weak through this period. The dollar, the run during the bust, when I think it's a flight safety trade and people run to the dollar whenever you get into crisis around the world. I think that move to 120 and maybe higher is the last hurrah. So that's a 2022, 2023 story. From that point forward through the end of the decade, the dollar will slip probably back down under, towards 50 and under 50 eventually. And then, and who knows what it does in the total collapse. So I mean, I think we're talking about, I say we're at the end of a super cycle, which is what I define as the big cycle between two depressions, the 1930s and the 2030s. and you're in that last stage of the super cycle, last decade of it. And when it collapses, who knows what fills the void? I mean, that's the big unknown. Is I could be pretty depressing about what I think could fill it. History is ripe with what happens when when things really collapse. So, it could be totalitarian, certainly. So I just think people need to, I don't want people focused on that because I can't even forecast it. I can only tell you what I worry about. But I think people need to focus on, what's right in front of them. First the melt up, then the bust, and then the recovery cycle, and do the best you can to preserve your assets through all of that.
Yeah, well, this is a very dire forecast for millennials who had to graduate into the financial crisis of 0809, and now we've got a great 2030s to look forward to. But in all seriousness, I mean, right now, when we see 7% inflation, politicians are blaming the greedy corporations. And a lot of people are saying that, price controls might come in. I mean, we're literally moving into a completely different style of government than what this country was built on. So do you think that that's one of the measures that they'll use as price controls to kind of try to keep things suppressed?
I would hope not, but it is funny how history repeats itself. We had price controls back in the 70s, and it's just a joke. I mean, you can't, again, people don't understand the markets control things, not the government. The government never seems to learn that ultimately they're not in charge. If you try to suppress prices, it will only end up in a worse situation with higher inflation. So I certainly think they will try that. I mean, the government still thinks somehow that they're geniuses. They don't look at their history. They always try to fix things, but I know it's coming, but it's not going to work.
Can we avoid this massive bust at this point, or is it just inevitable because of what we've done over the last, not only just 2 years, but pretty much the last decade and more?
Yeah, I mean, as you can tell, my convictions are high on this forecast. I'm probably better at big picture than any of my stuff. I mean, sometimes I get in trouble doing short-term stuff, but I do some short-term. But the bigger picture stuff, for whatever reason, it's clear because it's a long track. You can kind of see what becomes as I say, when you stretch it out, it becomes more inevitable. In the short term, anything's possible. But I always say, with all of this stuff, anything is possible. I could be wrong for sure, or miss my mark by a lot. But my convictions are high that this is, we've done a poor job, and maybe it's an inevitability of big cycles that over decades this just happens. You can go back in long history, and decline and fall of the Roman Empire, etc. You go through these periods where you think it'll never end. When you're in it, it might be 300 years of greatness, and then it's gone. So I my conviction is high that that's where we're headed, but I can certainly be wrong.
Well, I mean, you seem really calm. It doesn't sound like you're building a bomb shelter for this future world. And I know you have daughters, you have children. So how do you tell your children to prepare for this?
They don't listen to me anyway. So I'm joking, but some listen, some don't. But basically, it's it's the same story of, you just want to be careful with your debt. Don't get overextended. Don't think that everything's always going to go one direction, and be prepared. And frankly, I tell people, not just my kids, but focus near term, because I don't want people staying up at night worrying about something you can't control anyway. So it really, they don't hear a lot of this. I don't spend a lot of time talking about the big gloom. They could certainly probably recite it to you from years of hearing me or knowing me, but I don't, I try to focus really on what the good things we have around us, rather than the gloom and doom. As I say, if I couldn't compartmentalize this, I probably would never sleep.
Right.
It's pretty gloomy picture, but I do. I really focus on what I can control now.
Are there specific things that someone like me can do to prepare for all of this? I'm a millennial, and I obviously don't want my future to be devastated because of what's about to happen in your forecast.
Yeah, don't believe everything you hear about crypto, first of all. I'm just kidding. But I'd say, obviously, the same thing I've said is know the risks. Kind of better to be early than late if you're investing, and basically don't overextend. Save for a rainy day, and do the best you can to maximize what you can in the next several years. Because I think there's going to be, we didn't talk about, but there's going to be a great opportunity, in my opinion, in the commodity sector in that recovery cycle. You know, as I said, it's going to be new leadership. So it's not going to be all about the FANGs and tech next time. It's going to be, a lot of it's going to be about old economy, industrial, and particularly commodities. So you're going to have a period of time to build a nest egg. So for millennials who are just getting, early on in their savings, don't get too discouraged during the bust. Take advantage of the opportunities that are going to be handed to you. Don't be too early trying to jump on things. But when you see opportunity at so-called bottom, understand it's not all gloom and doom, even though you're right in the middle of it. And I mean, I'm talking about $400 oil next cycle. So, and I mean, I'm also talking about sub $30 oil in the bust. So if you can go from, $30 oil to $400, obviously there's going to be some great opportunities in that sector. I'm talking about gold going to 10,000 plus, silver going to $400 plus. So those are numbers that are tremendous. At the same time, I'm saying, the highs we make in this melt up will probably in the stock market will probably not be seen again. Certainly in my lifetime, maybe not in yours. So you can see there's different, depending on where you put your money, you can be, if you can take you and your neighbor, and one puts their money in gold, silver, and oil stocks in 2020, in early 2023 or mid 2023, and your neighbor puts all their money in the S&P index, you're going to have totally different outcomes by the end of the decade. So it really makes a difference how you allocate your funds. And unfortunately, as you said before, kind of the standard 60-40 mix that worked for so long because we had a tailwind of lower interest rates and higher price earnings ratios, we're going to be facing the exact opposite environment in the decade ahead.
Well, you brought up crypto, and Bitcoin does not equal crypto. So have you looked into Bitcoin at all? Since we last talked, can I orange pill you in a session after this?
No, people don't want my opinion. I'm a dinosaur and not really there, but I do see troubling things there. I just think there's an awful lot of people that jumped on it because of the momentum. I'm sure you're seeing a little different environment with what's happened in the last month or two, and that's healthy. I mean, so I don't know what crypto is going to be coming out of this, but I have my concerns because there's an awful lot of belief that this is the solution for what I just described. It's not. We're not. What I think comes in the 2030s is not likely solved by private currency outside the central bank system. I don't think that's what we're going towards, and yet that's kind of a narrative I think that has captivated a lot of crypto investors and Bitcoin investors. I don't know if I'm right, but
would you ever be willing to do a different chat where we kind of discuss that and why you feel that way versus why we feel so differently?
I have enough haters on my Twitter feed. I don't think that would be a good idea.
No, you would have a lot of lovers from Bitcoin supporters. Well, thank you so much, David. This has been wonderful. Anything else you just want to share as sort of a final thought, or, anything that you want people to watch out for or know, also including your newsletter?
Sure. Yeah, I think we covered a lot. I'm trying to think if there's anything really that we missed. The commodity cycle is going to be across the board. I think ag commodities will do very well, extremely well. I think the copper and the metal, the non-precious metals will do very well. So it's going to be a big cycle for commodities. And there'll be lots of opportunities there. So I don't want people to think that the end is here and there's nothing to invest in. There's going to be a runway ahead, but you just have to kind of know where to go. In terms of finding me, I'm on Twitter every day, for good or for bad, and you can find me there at Dave H. Contrarian. And I do have an investment letter that I offer by subscription. So if people are interested, they can direct message me on Twitter. There's a cost to it. So I have lots of people that will, after these things, will direct message me and say, can you sign me up for your letter? I go, well, there is a fee involved. So it's by subscription.
Awesome. Well, last question, as just sort of totally devil's advocate, what could possibly allow the Fed to keep kicking the can down the road? And, now we're getting to David forecasting 7,000 S&P, 8,000 S&P. What can they do? For sure, my targets, as you've seen, my targets have been raised several times. Coming out of the 2020 swoon, I think I had 4,200, 4,000 or 4,200, and then it went to 45, and then 4,800, and then 5,300, 5,000 and 5,300. Now it's 6,000. So there's nobody has to think that I stop at 6,000. It's certainly possible it goes higher. This was a pretty big jump when I raised it in this letter. When I wrote my last letter, I looked carefully and I said, I could have gone to 5,500. I said, no, I really think, I may as well go where my conviction is, and 6,000 is my conviction. Mm-hmm. There's no formula for this. So when you get in the parabolic, it can certainly exceed. I don't know whether I'll just kind of let it go and not try to target it, or whether I'll have a higher target or not. But I do think the time is near. I think this will burn out within the first half of this year. It doesn't mean it couldn't go to July, or that I could be premature again. But my conviction is that it's first half of this year. 6,000 is pretty close, and that the Fed's going to at some point. The thing you should watch probably is inflation. You could have inflation. Actually, the reason I think the Fed's going to have to give up on tightening for a little while is because the economy is really decelerating quickly here. If inflation also decelerates, that will be even more music to give more reason why the market will take off. So the thing to watch will be inflation, because I'm not so sure inflation it decelerates much, because of my history, my experience with the inflation back in the early 80s. Mm-hmm. Once it breaks out, it really goes one direction and isn't easy to put back in the bottle. So you could have a month or two. CPI could come out this week and be surprisingly lower. It doesn't mean anything. It's a one month. Right. But if it happened for a couple months, that would just probably cause the Fed to say, "What are we doing? We got to ease, or at least not tighten." But yeah, I'm going to stick to 6,000 for now, but it's not a guaranteed top. All right. Well, the music's clearly still playing. We will be watching, and thank you so much for this and for all you do, David.
Okay. Thanks, Natalie.